The Big Beautiful Bill kind of sounds like a Netflix docuseries about a charming con man who almost got away with it, but instead of stealing your money or marrying rich women, I guess, this one might actually let you keep a little bit more of your own money. We're going to skip the government budget talk, and we're just going to talk about how this affects your paycheck, your investments, and your overall financial plan, and clear up some of the big myths, especially about Social Security. You're going to want to stay tuned for that one. Let's get into it.
You're listening to Advised with Rick Lucchini.
The key tax changes. And this is a big one. No change to the tax brackets. Seems anticlimactic, I assume, but these are historically low brackets, and they were set to revert to pre-2017 numbers in 2026 had this extension not get passed. It's a big deal. 12%, 22, 24% brackets, they're all still here. In a world where Congress letting something expire can raise your taxes without having to pass a new bill, this is actually a really big win. New deduction for seniors, $12,000 married, $6,000 for single filers over 65. Modified adjusted gross income under 150 for married, 75 for single. This deduction helps lower income for retirees, and yes, that's part of the confusion around the Social Security headlines. No tax on Social Security. That's not what's happening here. If your taxable income drops low enough because of this deduction, your Social Security might no longer be taxed or at a lower percentage. But if you've got a decent retirement income, you got dividends, IRA withdrawals, capital gains, maybe you're doing Roth conversions, you're still likely in the 85% taxable zone for your Social Security. This deduction is nice. We are going to use it. It may allow us to take a little bit more withdrawal. It may allow us to convert a little bit more to Roth in a particular year or harvest more capital gains. We're going to use it. We're going to plan for it, but don't expect your Social Security to magically stop being taxed, okay? How the no tax on tips works is similar to the overtime where you get a actual tax deduction. So I'm not really sure how the withholding is going to work. It might depend on who you work for, but likely what's going to happen, your paycheck may feel similar. You get a bigger return when you file your taxes. I'm not really sure about that yet. It may depend on per employer or how their payroll system works. Cash tips, and that not just literal cash, but the POS system that everybody uses now and everything still, as far as the IRS is concerned, is a cash tip. You're going to get under those income thresholds, 150 for single, 300,000 for married couples. You get up to a $25,000 deduction towards those tips. It's actually a pretty big deal. For a couple, one person's a server and one person, has a normal 9-to-5 job. It could be their tips could be 25% of their income, let's say, over time. This is a good one though. This one has a little bit of teeth. Up to $12,500 deduction for single filers, $25,000 for couples. Same income limits, 150 single, 300,000 for couples. So a couple under $300,000 income working overtime gets up to a $25,000 deduction towards that overtime. Again, for federal tax, not state and not Social Security and Medicare or FICA as it looks like on your paycheck. This one does work though, right? Because that extra overtime, having that not be federally taxed does matter. It does make your paycheck a little bit bigger. Having to pay the Social Security and Medicare tax, the FICA, which is always a big pain point for people when they work overtime. It is a big deal because one of the unintended consequences of literally no tax on overtime and tips would have been that if you don't pay into your Social Security, and that's a big part of your income, especially for the tips, but People that work a lot of overtime, I mean, sometimes it could be 30, 40, 50% of their income. They're getting double time, triple time, working holidays, weekends. If you're not paying into Social Security, you're dramatically reducing your future Social Security benefit, which for those middle to lower income workers will be a larger percentage of their retirement income. So still having to pay the FICA on it's good. Capital gains, qualified dividends, preferential rates remain intact. I mean, again, a no change is a win. Having the 17 tax cuts sunset would have meant these numbers go up. They don't. So whether you're younger and saving in a taxable account and it produces dividends and some gains when you're making trades and things like that, especially when you're in a higher tax bracket, this matters. When you're retired, and same thing, you have dividends, you have capital gains, you're taking withdrawals, so there's more trades, there's more gains. This matters. This is still a very tax-friendly way to invest if done right. Do a different episode on that. Spoiler alert, get rid of your nasty mutual funds. You can really invest tax efficiently in these accounts when done correctly. And the current tax code and the tax code extension around these accounts and qualified dividends and capital gains just makes it that much more beneficial to use these types of accounts. Roths and IRMAA. If you don't know, IRMAA is a Medicare surcharge. When you're on Medicare, have certain income limits, you start to pay more than your neighbor. Nothing changed. No rule change for Roth conversions, backdoor Roths. That's a good thing. They're not shutting the door on any of that stuff. We're still able to do it, plan for it, and that's important. IRMAA thresholds haven't changed. Don't love that, actually, but I guess you got to pick your battles. For what it's worth, I don't think IRMAA surcharges should exist. I'm all about paying your fair share, but when you're paying into Medicare, when you're working, there's no limit on the amount you can pay into it like there is on Social Security. You pay up to the income limit on Social Security. If you're a high wage earner, then you stop paying on Social Security after that. Medicare keeps going. You just pay no matter how much you make. So for a high wage earner, they're paying significantly more Medicare tax throughout their working career. Then when they retire and are on Medicare, likely their income is still high and they pay a higher Medicare premium because of that. To me, I'm all about paying your fair share, but to me, that stops when you really just start getting penalized for being successful. So again, that could be for another day, but there's no changes there. So we still have to, for planning purposes, we still really have to pay attention to IRMAA limits. This comes into effect, especially when you're doing some tax planning, doing Roth conversions. Don't be going out there doing that stuff willy-nilly, because you're going to trigger some things that you weren't aware of, and it's going to cost you more than it saves if it's done incorrectly. So let's get to the part that matters. How does it really affect you, depending on who you are? In summary, plain and simple. Retirees continue to have stable brackets and no surprise increases. Okay. This is a big deal. Again, outside of business owners, retirement is the first time that you really get to have a say in how and when you're taxed. A real tax plan in retirement is strategic around when things are taken, where they're taken from. Keeping the brackets the way that they are allows us to continue to strategize that way and just ultimately pay less tax by doing the same exact things. Add in your additional senior deduction if you're over 65 and under the income limits. Got a little bit more room to play. Okay. If you are low income, the new deduction might lower your Social Security tax. That's what all the buzz is about. It's just the new deduction. It's not really no tax on Social Security, but you're in a good spot. Nothing got harder. Nothing got worse if you're in retirement. Okay. So, no free lunch. We're still paying tax. We're still paying attention to important tax points, but nothing got worse. And that's really powerful. And it helps stabilize the market too, which is likely where your biggest assets are because it's predictable. Working class and overtime earners. Okay, you get the overtime deduction, and that could reduce your taxes slightly. The lower, same as everybody else, lower brackets are preserved, so we're not automatically paying higher taxes just because something didn't get extended. And the much higher child tax credits got extended, which is going to help most of you because you've got young families. So if you're grinding for extra hours, you're just going to keep more of it, but you're still paying taxes. You're still paying state taxes, and you're still paying Medicare and Social Security as well. So just be aware that when you're doing that mental math on what your time and a half is, you still don't get to keep all of it. Okay. Higher earners, Henrys out there, no bracket increase. Same as everybody else. Historically favorable tax environment. Keep earning, keep saving. Backdoor Roths remain open. It's a great planning opportunity. Get a backdoor Roth strategy built for you. Take a look at it, see how it affects you and how it might work for you. You still need proactive tax planning and investment planning and these taxable brokerage accounts. Again, with the preface that it needs to be invested and managed correctly, is still probably one of the most powerful tools for you because of the tax-friendly nature now, but specifically in the future when you're older. You're not going to be a high wage earner for 34 years and then all of a sudden retire and make $40,000. This concept of I'm in a higher bracket now because I'm working and I'm going to retire in a lower bracket. It's not real. It just is not real. Okay. Because you save all that taxable money right now. When you go to retire, yeah, your income's lower, but then you need to actually spend that taxable money, which puts you back up. Tax planning, proactive tax planning for everyone. But if you're a high wage earner, you're still working, start planning now. So there it is. A bill that's got a name that sounds like a contestant on The Bachelor, but it really does help at least a little bit. For retirees, steady footing. For workers, a small leg up. For higher earners, your planning window remains wide open. If you're a client, we've already reviewed how this specifically applies to you, and we'll be reaching out shortly with that analysis. If you're not a client and your advisor hasn't said a word about this bill yet, well, might be something to think about. Thanks for listening. Until next time, keep your taxes low and your plan tight.